In this recording, we're looking at the September 2019 question 2 focused on consolidated financial statements. So again, consolidated financial statements in terms of the financial statement preparation themselves, but also calculation of journal entries are a very common requirement in this interim assessment. So it's important you put in a good lot of work, and it will also be on your final exam as a compulsory question. So again, this question here is asked us for 3 requirements. Calculate the goodwill arising on the acquisition in May 2017. 5 marks. Calculate in respect to 2018 the unrealised profit, 4 marks, and then prepare consolidated statement of financial position. Now, to some extent, you're going to be doing A and B as part of C anyway, so I'd always do them all as a single part, and then you can label them as required in your answer booklet. But just remember and have a look at some of the answer booklets from previous past papers. There most likely will be a box left for your calculation for this, and a box left for your calculation here. So make sure you put the answer in the required box in your answer booklet in the day of the exam. What isn't asked here is debits and credits, but I'll give you the debits and credits just for practice as well to make sure you remember that, because it has come up in other exam papers, including I think January 19, where you had in question 2, if I just double check here, you had journal entries related to the acquisition of a subsidiary as well. So you need to know your journal entries and consolidation. So we're going to have a quick look down through. They give us the parent, which we'll call V, and the sub, which we'll call L. So that's at the year end 2018. So remember, this acquisition occurred last year. So that is 20 months ago. So 1st of May 2017. So it's a prior year acquisition. You bought 70% in the subsidiary. And you can see that 2.5 here. That matches the 2.5 here. So they've already recorded the investment. We need now to take out that and bring in the subs, assets and liabilities. Date of the acquisition, the equity section was ordinary share capital and retained earnings. So on the 1st of May 2017, retained earnings, this is the kind of things you're looking for, were $1 million. They're now $2 million. So the difference between those two figures, from the date of acquisition to the reporting year end 2018, that is post-acquisition profit, and that will have to be allocated out. We then have a fair value adjustment at the date of acquisition of a factory, which is 600,000 bigger than its carrying value, and you have to be depreciated. Then we have intercompany sales during the year between the parent, Verakern, and the subsidiary, Ladane. And we also then have an intercompany payable and receivable at the year end, and we're told the NCI is measured at its proportionate fair share of net assets. So there's 2 ways NCI can be measured, either at its fair value, not in this case because we're not given it, or at its share of net assets. So your first starter point of call usually is your goodwill working. So I'm going to call this working 1 goodwill. You're going to have a particular box for it in the exam because it is part A. So just be careful in terms of how you lay it out, but make sure you clearly label your workings. That's a big limitation based on examiner feedback for question 1, your IAS 1 question, and question 2, which is often a big consol question, is poorly labelled workings. So to calculate goodwill then, we're going to look at the parent and we're going to look at the NCI. The parent is 70%, the NCI is 30%. Now there's a number of ways of laying out this, but you can do it whichever way you want, as long as you come to the same answer. So in terms of the investment then, our parent is going to be 2.5 million. That's coming directly from the question. Right? They invested 2.5 million. And our NCI, we don't know yet. We'll leave a question mark there. That will be dependent on what the fair value of net assets is. So in terms of net assets at acquisition, so we have to slot these down. The net assets at acquisition, they'll be ordinary share capital, retained earnings, and your fair value adjustment. So at the date of acquisition, you had retained earnings of $1 million, ordinary share capital of 600,000, and a fair value adjustment of 600,000 as well. So we call that the fair value of net assets at the date of acquisition, or 2,000 or 2.2 million, because all of these figures are in with 3 zeros taken off. So that means the NCI is going to be 30% of 2.2. It's its share of fair value of net assets. That's what they mean in terms of the note that's given to you last there, note 6. You get the fair value of net assets and you get its ownership share, which is 2,200. So that means the total investment there, parent is 70% plus NCI 30% is 3160. And your goodwill then is the difference, which is the investment minus the fair value net assets, 960. And just for illustration purposes, but it's not required, the share of net assets here will be 70% and the share of net assets here would be 30%. So what we're trying to show is there is no goodwill attached to the NCI. When you use this method, which is also called method 1, the NCI is just measured at its share of net assets. So it's a nil. All the goodwill is attached to the parent. So your goodwill and acquisition is, sorry, that's wrong there. That should be 25 minus 1540, which is your 960. So you don't need to show that split here. It's just for tutorial purposes. What you wanted for part A for your 5 marks is the 960. Now it's not asked, but it's no harm to know in the question, what are the debits and credits? Well, the debits and credits here are, you're going to debit ordinary share capital to remove it, 600,000. So I'm dropping the last 3 zeros. We cannot debit the individual assets and liabilities here because we don't have them. This acquisition occurred 1st of May 2017. So we don't know what the assets and liabilities were. All we know is what equity was. So you remove the ordinary share capital. You debit retained earnings, 1 million. You debit PP, 600,000. That is increasing the property, plant and equipment, the fair value adjustment. So I put in brackets there, fair value adjustment. You will credit NCI, creating an NCI 660. You will credit the investment. That 2.5 million, which is an asset in the parent's accounts, should be removed. And the balancing figure that should be debit goodwill to create a goodwill asset, 960. And just to double check, all our debits sum to 3160, all our credits sum to 3160. So if you're asked for the debits and credits, as you were in January 19, and a number of other question 2s, that's the debits and credits that are required. You can't debit and credit assets and liabilities individually because we don't have them. Unless the reporting date is the same date as the financial statements, you have to take this approach because all you know is the equity at that equity section at that date. So that's your part A. What we're going to do now is we're going to go through each of the other workings before we prepare the financial statements. And usually the workings are do your retained earnings, do your NCI, and do any other adjustments you might have in the financial statements. Right. So our next adjustment that we're coming to, we'll just do them in order here. So we've dealt with 1, we've dealt with 2. 3, we've dealt with the fair value adjustment. We haven't dealt with depreciation. So we can try and pause it and make sure in terms of working 2 that we can deal with fair value depreciation. Because if we're increasing our factory by 600,000, you must depreciate it as well. So you have extra depreciation, and that is going to be 600,000 divided by 10 years, because the useful life is 10 years. We have to be careful here now is, it's the policy to charge proportionate depreciation. What that means, you go from the date of the transaction to the year end. So you're depreciating from the 1st of May 2017 to the 31st of December 2018. So that is actually going to be times 20 over 12, 20 months. 8 months in 2017. From May to December, 12 months in 2018. That was a tricky one that a lot of students got caught out on. So it's going to be 60,000 for 1 year, 600 divided by 10, times 20 over 12. 100,000 extra depreciation. Alright, so that's an important one that you put a bit of practice into. Read the question carefully or you will get caught out. Okay, so then you're not asked for it here, but no harm to know the debits and credits. That will be debit, group retained earnings, debit NCI, and credit PP. You're charging extra depreciation 100,000. That's 30, and that's 70 because you're splitting 70-30. I've just dropped the last 3 zeros. Now, some students may not be used to this approach, and they may just say instead of that, you may just write debit cost of sales of the sub 100. And if you write that instead, that's fine. Either of those are acceptable. It's definitely going to be credit PP 100. But I always write it like this to remind you, you're splitting that because when you're charging extra depreciation, you're charging extra depreciation in the subs accounts. that must mean you have to split it between the sub and the parent. I split it directly in my working. Some students wait and they split it then on the financial statements. Either or is fine, but you must split it at some stage. Working 3 then, which we're looking at now, is the unrealized profit. So the unrealized profit we're asked in part B, that is going to be here. You're told Veracaran sold goods to the subsidiary. So that's important. The direction is your parent is selling to the sub. Parent is selling to sub. That's important because it depends then where the unrealized profit is. In this case, the unrealized profit is in the subs or the parent's accounts, so it does no impact on the NCI. So direction is important here. So the sales were 420. The costs we don't know, and then we want the profit to calculate. So your cost here, we're not told it directly, we are told that it sells goods in a markup of 40%. That means this is 140% of cost. That's how markup works. So 420 is 140% of markup of cost. So get your cost here as 420 divided by 1.4. So 420 divided by 1.4 is 300. And your profit, the profit the parent made on those sales is 120,000. Now remember, we're not asked about profit, we're asked about unrealized profit, URP, which is going to be 25%. We're told in the question 25% of the goods remain unsold. That's the unrealized portion. Everything else has been sold outside the group. That is realized and we don't make an adjustment. So your unrealized profit there is 30,000. And the debits and credits here, be careful now. This is unrealized profit in the parent. So that's why direction is important. So you're going to debit group retained earnings. Now technically you're also debiting cost of sales, so either of those are fine, 30. And you're going to credit inventory 30. So you're not asked for the debits and credits, but it's no harm to practice them. So if that was the other way around and the sub was selling to the parent, then the sub's profits would be overstated and that would be split 70-30 like we did up here. So that is why the direction is very important. So to get your, I think, 4 marks there for part B, you have to show that calculation. You didn't require the journal entry, but it's no harm to know where it is. Because you will have to do it in other questions. Right. And then our working 4, we have an intercompany balance between the sub and the parent at the year end, and they match. This agreed with the corresponding receivable. We know under IFRS 10, you can't owe money to yourself in terms of group accounts, so you eliminate them against each other. Sometimes there can be differences and you have to reconcile them. That's called goods in transit and cash in transit, and that has come up in previous papers, but we don't have it here. So all we do here is debit trade payables as a group, credit trade receivables, to eliminate those 200s against each other. And that's all you're required for your working 4, and you'll show that in the financial statements. And so they're key elements. We're just working down through each one, and you need to practice these. These are quite common to come up, and there's lots of questions to practice on, and plenty of recordings on the DoubleExit site as well. Before I would jump into part C now, doing the set of financial statements, I'd always do my 2 last big workings out, so I can just cross-reference them in. So that's working 5, NCI, and I'll do working 6, group retained earnings. Those 2, along with goodwill, are where most of the marks go for in consolidation questions. You need to know how to value them. So for example, the value at acquisition for the NCI, working 1, that was 660. We know during the year, they will have got post-acquisition profits in the sub. So the post-acquisition profits in the subsidiary, we've previously alluded to. When we purchased it, retained earnings were €1 million. They're now, 20 months later, post-acquisition, they're now €2 million. So post-acquisition profits for the subsidiary are 1 million. And that is 2 million minus 1 million. Post-acquisition. And the NCI share of that is 30%. So they're going to get 300 of that share. And you add that on, because it's increasing their share of the profits. They own a portion, they get a portion. And we also have one other adjustment up here, which is debit NCI 30. That's the credit NCI 660 to start off. In working 2, then we reduce the NCI working 2 depreciation minus 30. So closing NCI at the 31st of 12th 18, you add those up and your answer is 930. That's going to be cross-referenced just working 5 in the statement of financial position. Right? So it's not a bad one, but it's about practice and knowing your approach to NCI. Another way students could have done that, just to show you the difference, if you left that whole and said, I didn't split it 70-30 and I just did 100, what typically students would show there was they do post-acquisition would be 1000 minus 100. They do 900 at 30%, so I'll just remove this to show you. And that 900 at 30% would get you 270, and you still get your 930. So either way is fine, as long as you know exactly what approach you're taking. I do always that full and make my adjustments. I directly take off the 30% like this. Some students put the full adjustment in and only take 30% once. Both answers will get to 930, both will get full marks. The other big adjustment we have then is group retained earnings. Your starting point is always the parent retained earnings in this working. Parent retained earnings we know are 2 million at the reporting period. We do the exact same approach as before. We do the post-acquisition profit to the sub are 1 million. The NCI gets 30%. The group gets 70%. So you just add on 700 there. So there's a nice symmetry between those two workings, and they are always done at the end. Now you have to be careful because we also have working 2 depreciation. And we are getting hit with minus 70 because we debited group retained earnings here, 70%. You could also do it the other way and take off the 100 directly and take 70% of 900. 70% of 900 will also get you to the 630, the sum of those. Either way is fine. In addition to that, what we didn't have in the NCI is we have the unrealized profit. That was only debit retained earnings of the group because the parent was selling. That is going to be another minus 30, working 3 URP minus 30. So again, you can see nicely, neatly laid out, and you cross-reference your workings. Go back and read the examiner feedback. The biggest complaint the examiner has is students aren't cross-referencing the workings. So that should hopefully get us, that parent retained earnings. Be careful, I'm taking the sub there. The parent retained earnings should be, of course, 10,640. That's my mistake. Just watch out for that again. And then you come and tot them all up. And that gets you 11,240 group retained earnings, 31st to 12th, 18. And you're going to cross-reference that in the statement of financial position. So we have a lot of the big workings done before we go in. And we can have it nice and neat then when we finish off with financial statements. And all of these get marks. So remember, your workings will get marks as well. So don't forget to put them in. So the final piece then is to bring it all together. And we're going to have a consolidated statement of financial position as at the 31st of December 2018. You have assets, non-current, and then we have current, and that will get us to total assets. So we'll start with this side first. So again, try and be neat in the exam. You're going to have to give your headings, so don't lose out on easy presentation marks. There are always presentation marks going. And you're working off these figures here now, and you're also working off the notes to the accounts. So here in your non-current assets, we have PPE. Now, I would tell students, leave your right column there, and what I do is I would just show in brackets where the figures are coming from. This is going to be parent, 10.2, plus sub, 2.2. They're the obvious ones. You always do parent plus sub, but be careful now. Plus 600, working 1, which is our fair value adjustment, minus 100, working 2, which is our fair value depreciation. So just try and cross-label to show exactly the examiner where the figures are coming from. So 10.2 plus 2.2 plus 600 minus 100. So your closing property, plant and equipment should be 12,900, and we'll put that as euros. So whatever way you do, try and make sure that you're trying to keep it neat and show the examiner where it's coming from. The other one that we don't have there, the investment is not included now, we have goodwill. And I'll cross-reference there working 1, and that will be 960. So your total non-current assets are 13,860. Nice and neat, and cross-reference your workings. That's what the examiner is looking for, and that will only come in practice, particularly under time pressure. Here then you have inventory, you have trade receivables, and you have cash. So similar to before, it's parent plus sub. If there's no adjustments, I just write down P plus S and slot in the figure. If there are adjustments, I'll be a bit clearer to the examiner. So for inventory, for example, it is 900 plus 500. That's clear to the examiner where it's coming from. You don't need to tell him it's parent plus sub. But be careful now, we also have minus 30. And that is for your working, just we get the right working to cross-reference. Your unrealized profit, working 3. We credited inventory. Working 3. That's going to be 900 plus 500 minus 30. Nice and neat. Same with trade receivables, just parent. 200 plus 400 minus 200. And that is coming from working 4. That is the intercompany balance between the parent and subsidiary. See there, the 200 intercompany payable. So you reduce your payables, reduce your receivables. So that's just going to be left with 400. And finally then cash, some people just slot it in. It's just parent plus sub, 640 plus 300. No other adjustment to cash, it's 940. So your total current assets then are 2710, and your total assets are current and non-current. 16,570 of a balance. So that doesn't take that long. If you set up your workings neatly and you have a good template that you know how to approach it, you can actually get the statement of financial position done quite quickly. But it takes a bit of time, and of course it takes a lot of practice. So we then do equity and liabilities. And so your equity and liabilities, it's important to get the presentation right. Equity always comes first. And remember, the examiner is giving you the layout in the question, so make sure you use it. Then we go, there's no non-current here, so it's just current liabilities. And then the final one is total equity and liabilities. So there shouldn't really be too much of a problem in terms of layout, because the examiner gives you the headings. So they make it very easy to make sure you have it appropriately laid out and get the 1 or 2 presentation marks that are going. In terms of equity, we have ordinary share capital and you have group retained earnings. Right? The other new one that you won't have there, that you need to remember to put in, of course, in the group financial statements, is you have a non-controlling interest. That is always in the equity section as well. Ordinary share capital is only ever the parent, 2,4. So remember, technically you're adding the parent and the subsidiary together, but if you remember, up in our first journal entries where it comes from, we debited ordinary share capital 600. So we're removing that subsidiary share capital, that goes towards the goodwill working. So that's where those debits and credits make sense. The group retained earnings, all we do there is reference working 6, I think it is, and that's going to be 11,240. So that's the benefit there. You don't have to show detailed calculations here, because it'll be quite messy and you might be able to read them, or the examiner might be able to read them. And same with NCI, working 5, nice and neat, and 930. So your total equity is 14,570. But again, that's the big benefit, and that'll be important for going towards the June exam as well, where you have much bigger consolidation questions. You need to be strategic with your workings, cross-reference them in, keep the financial statements neat, because it gives a good impression to the examiner. Then current liabilities is just trade payables, and that is going to be the 1,400 from the parent, plus the 800 from the subsidiary, minus the 200 from working 4. And that is corresponding to, on row 53, the 200 taken off trade receivables. The balance between the parent and the subsidiary are eliminated against each other. Reduce receivables, reduce payables. And that will get you 2,000. And when you add those two together, your liabilities plus your equity, thankfully, we balance up. The total assets, 16,570, balance to the total equity and liabilities, 16,570. Right? But that is a common question in examiner in the CAP2 interim assessment is a number of workings plus the consolidated statement of financial position. So you need to go back and make sure you know the basics of consolidations. It might be the first time you've covered a CAP2 from this year onwards, so it can be a steep enough learning curve. And so what you need to do is look at calculations, look at the financial statements, but do not forget also the journal entries related to consolidation. Because if the examiner doesn't want to ask a full set of financial statements, they might ask you smaller journals. And that's where students are getting caught out, particularly in January 19. So that was the September 2019 question 2 focused on consolidated financial statements.